Howdy, everybody. Welcome to Liberty Call. Today is Tuesday, December 17th, 2024. Hope you're having a fantastical day out there in the interwebs. It's a pretty nice day here. It's been kind of overcast here and there, but not too bad. Not too hot, not too cold. Well, it's a little chilly, but it got real cold last night. I was out grilling steaks, and I was wearing sweats and long sleeves, and even running out to the grill. I was like, "Rrr." So anyways, hope you're staying warm. It's not winter yet. I guess winter starts in a couple days or sometime next week. So, all right. Well, before we jump into the numbers, I need you to do me a favor. I need you to give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All right. Well, now we can get into the news. What happened in the markets today? According to my screens, they were red all day. Dow Jones was down 0.61%, 267 points, closed at 43,449. S&P 500 down 0.39%, closed 23 points, closed at 6050. NASDAQ down a third, 65 points, closed at 108. The VIX was up 8.1% today. It's at 1588. Canada down 0.11. Brazil up 1.08, and Mexico down 0.69. In Europe, Germany was down 0.3%, the UK down 0.81%, France up 0.12%, Netherlands down 0.2%, Spain down 1.62%, Italy down 1.22%, Switzerland up 0.28%, and Portugal down 0.8%. Russian exchanges again in the red. MOEX down 1.67%, RTSI down 1 3/4%. And the overnights, the Nikkei in Japan was down 0.13%. Australia up 0.78, New Zealand up 1.38. In China, the Shanghai was down 0.73, the Shenzhen component down 0.35, China A50 up 0.7, DJ Shanghai down 0.66, Hang Seng down 0.48, and the Taiwan weighted up 0.08. All right, so those are the markets for today, folks. Everyone's on pins and needles because the Fed meeting started today and it ends tomorrow. So I guess I can get rid of my 2024 Federal Open Market Committee meeting calendar and put one up for next year. So last year or the year before, I was writing all the different changes that they were doing. This year was pretty slow, so I didn't bother. So, all right, well, let's get to the market recap and see why everyone was in a sour mood with the markets. U.S. stocks fell on Tuesday as the tech sector retreated from its recent highs while investors adjusted expectations ahead of the Federal Reserve's final meeting of the year. Retail sales grew at 0.7% in November, surpassing the 0.6% forecast, indicating the U.S. economy remains robust. Really? Fooled me. Despite elevated interest rates, the data underscores continued consumer spending resilience. The Federal Reserve is expected to cut rates by 25 basis points at the conclusion of its two-day meeting tomorrow. However, investors' focus will shift to the Fed's outlook for interest rates in 2025, particularly as sticky inflation and labor market strength remain key concerns. If I could pause here. Well, you can't have both. You can't have low interest rates and fight inflation. You got to pick your battles. So, I mean, since inflation is really the bugaboo and causing all the issues in our economy the last 4 years, and really putting a strain on the lower income folks, I deal with inflation first. That'd be me. I mean, because that would help the most people. Is it going to be painful to have interest rates at 7, 8, 9% for a while? Maybe. But we made this bet. We got to either deal with it or just deal with the consequences long term, which could be a financial collapse or whatever. Where were we? Goldman Sachs analysts no longer anticipate a January rate cut and expect the Fed to ease rates at a slower pace next year. Markets are pricing in an 81.9% chance that rates will remain unchanged in January, according to the CME FedWatch tool. The tech sector declined after recent gains, with NVIDIA falling 1%, deepening its correction with a 10% drop from its recent highs. However, Tesla rose after Mizuho upgraded the stock to outperform and raised its price target to $515 from $230. Wow. Citing expected benefits from loosened regulations. Pfizer climbed 4.3% after projecting 2025 profits in line with expectations and outlining plans to reduce debt and cut non-core businesses following the declining COVID-19 product sales. Meanwhile, crypto stocks surged as Bitcoin continued to rally, surpassing 107,000. This momentum lifted Coinbase Global and MicroStrategy shares. The market now awaits the Fed's commentary on future rate cuts and the broader economic signals. All right. So that's what's going on there. I mean, again, you can't do both. I mean, you can't have low rates because that creates easy credit, which then expands the money supply. Or you shrink the money supply, which, would probably create some deflation and, help out, the American consumer. But, big business is so afraid that, if there's any deflation in the economy, that it's going to create this vicious spiral. The Keynesian economists just hate it for some reason. I don't know. I wouldn't necessarily mind paying less for my eggs and milk and stuff. All right, next up, I got some data. November retail sales. This report comes from First Trust. Mr. Nate Gursey put it together. Let's see what he had to say. All right, the holiday shopping season starts strong as retail sales rise in November. Retail sales increased by 0.7 in November, slightly surpassing expectations as Black Friday and Cyber Monday discounts encouraged record consumer spending. However, inflation remains a factor, making spending appear artificially strong. Yeah. Key categories and core sales. The biggest drivers of the increase were autos, 2.6%, and non-store retailers, up 1.8%, both reaching all-time highs. This masked mixed results elsewhere as 7 of the 13 major sales categories rose, while 6 declined. Core retail sales, which exclude volatile categories like autos, building materials, and gas, increased by 0.2%. If unchanged in December, core sales will grow at a solid 4.2% annual rate in Q4 compared to Q3. Notably, restaurant and bar sales dropped 0.4%, marking their first decline since March. Year-over-year sales, these sales are up just 1.9%, a significant slowdown from the 11.1% increase in November of last year. This sector remains a key indicator of consumer spending on services, which rebounded after suffering during COVID-19. Well, whose fault was that? The impact of inflation. Overall retail sales are up 3.8% year over year, but inflation-adjusted real retail sales have grown just 1% and remain below their early 2021 peak. This underscores inflation's impact. Consumers are paying higher prices, but receiving fewer goods. While the Fed is expected to cut rates by 25 basis points this week, inflation remains a concern. November import prices rose 0.1% and export prices were unchanged, with yearly increases of 1.3% and 0.8% respectively. The Fed faces the challenge of balancing rate cuts with the need to ensure inflationary pressures don't reignite, even if economic challenges arise. Well, I don't think they ever actually extinguished the inflation to begin with, so the fact that it sparks back up is not a surprise. All right, got some more data, also from First Trust, November industrial production and capacity utilization. This was put together by Bryce Gill. All right, industrial production fell again in November, coming in weaker than expected despite expectations for a rebound following the resolution of the Boeing strike and impact of recent hurricanes. Overall, manufacturing output rose 0.2%, driven entirely by a 3.5% surge in the volatile auto sector. However, non-auto manufacturing, considered a core measure, fell 0.1%, signaling underlying weakness in broader industrial activity. Notably, aerospace manufacturing, directly affected by the strikes dropped 2.6%. The high-tech equipment sector provided a bright spot, rising 0.4%, likely fueled by AI investments and semiconductor reshoring. High-tech manufacturing remained strong, up 7.4% year over year at the fastest growth among major categories. Mining and utilities weakness. The mining sector contracted by 0.9% with declines in oil and gas extraction, drilling, and other mineral production. The sector is expected to recover in 2025 as the Trump administration adopts a more aggressive stance on permitting. Meanwhile, the utility sector dropped 1.4%, driven by weather-related volatility. In related news, the Empire State Index, measuring manufacturing sentiment in the New York region, fell to a positive 0.2 in December, down from a 31.2 in November. And the outlook, despite strength in high-tech manufacturing, persistent weakness in non-auto production and mining highlights ongoing challenges in the industrial sector. The focus will remain on policy changes and investment trends to drive a recovery in 2025. All right. So, those earlier articles where we talked about how, the economy is strong and it's robust and everything. Well, there are sections of the economy that are not doing well at all, and they haven't been all of this year. So again, if people would open their eyes, read some, get past all the fluff on the front page of the newspaper and, dig into the actual data, you'll see things aren't that great. All right, one last article from Zero Hedge, some honesty about inflation. This was written by Jeffrey Tucker of the Epic Times. So let's see what Jeffrey had to say. The latest inflation data reveals ongoing price pressures with annualized inflation at 2.7%, far above the Federal Reserve's 2% target. Recent sticky price index figures show inflation at 3.9%, signaling persistent issues of that complicate the outlook for the incoming Trump administration. The M2 money supply, which bottomed out in October of 23, has surged by $1.9 trillion, fueling inflationary pressure. Combined with increased velocity of money and bank lending, the inflation outlook remains concerning. The Federal Reserve faces a dilemma: lower rates to stimulate growth, risking further inflation, or maintain rates and face recession risk, potentially angering the new administration. There's no mention about raising rates. Strange. Come on, Jeffrey. Historical comparisons, lessons from Reagan. In 1981, Ronald Reagan confronted a similar situation, high inflation and economic stagnation. His administration accepted an 18 to 24-month recession as necessary to restore growth, though it led to a midterm election losses. The current political and economic climate, however, is far less tolerant of such long-term solutions. Federal budget and spending cuts. To dampen inflation, significant federal spending cuts could reduce debt creation and alleviate pressure on the Fed. However, cutting $2 trillion from the budget necessary for meaningful progress would have tangible impacts on public services, drawing intense opposition from Washington bureaucracies and the media. Oh no, the people in Washington would be upset if the federal government spent less of the money that they don't have. Sorry, people are going to lose their jobs in the next few years. I just can't be any more blunt about that. If you have a federal job or a job that is a federal contractor, you're probably going to be out of work. I mean, either one or two ways. Either they shrink the government so that it's manageable, or it falls apart and you're just out of work with nothing. I mean, at least, a planned approach would be much more sensible. All right, no quick fix. The incoming Trump administration inherits significant challenges: persistent inflation, a weakening labor market, and stagnant real incomes. Hard economic choices, including a period of short-term pain, are required to restore long-term stability and growth. Without acknowledging this reality, hopes for a magic cure remain unrealistic. Reagan's experience highlights the need for patience and fiscal discipline to overcome economic adversity. And what can we bet on? They'll do nothing and everything will just get worse. So that's why you probably need to talk to a financial planner or a financial advisor. So feel free to give me a buzz. All right. Well, that's everything that I have to cover for today. If anyone, like I said, needs anything from me, you need to get your financial plan in place, go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call, give me a buzz, drop me an email. I'd be happy to help. And you can book a meeting on there. It's pretty easy. All righty. Well, again, hope everyone has a great night, and I'll talk to everyone next time. Adios.